All right.
Let's start it again.
We're up. What's up, everybody?
What's up, everybody?
So, we're in Fort Myers today, coming to you live. And today we're talking about refinances.
Yeah.
Because everybody's talking about refis. The rates are low. It's a good time to refi. Everything's looking good as far as refinancing because 6 months ago, 8 months ago, the rate was, a lot of people were closing in the 5s, and now we're well into the 3%.
Yes.
So it's exciting. You're probably getting a bunch of calls why you should and shouldn't refi, probably from us and probably from other people as well. Yeah. So does it make sense to refi? Does it always make sense to refi if you look at everything?
No.
And we want to talk about that today. Because a lot of times all we look at is, hey, I have a rate of 4.5. If I can refi, it doesn't cost me any money out of pocket, which is very attractive. In some cases, I don't need to bring one or even two mortgage payments. So I'm saving that money, right? I'm saving that money, and my payment is gonna go down. So let's just talk about why you shouldn't refi. What are the times where it doesn't make sense to refinance?
So look, I mean,
let's take some business away from us.
Yeah, screw it. But no, let's let's talk about it, man. I mean, look, there's two types of refinances, right? You have a rate term refi, as we call it in the business, where you're altering your rate and or your term, and then there's a cash out refi. So look, on the rate term refi, man, I think there's two motivations for it.
Rate term refi is I'm not taking any cash from my house.
Correct.
All I'm doing is working on the terms of your loan.
The terms of your loan.
Okay.
So, in my mind, there's two thought processes.
Okay.
There. One, I want to save as much money as I can.
Sure.
Two, I want to pay off my house as quickly as I can.
Right.
Okay. Let's talk about the first one. I want to save money. I think we have to have a conversation with people about how long they plan on staying in the house. I had a financial planner buddy of mine referred somebody to me. We were doing a refinance. As it turns out, she's going to sell the house in 2 years. This makes no sense to do it. Okay?
Why?
Because you got to factor in the closing costs, and you're kind of resetting the loan with things. And
there's a lot of costs associated.
There's it was a $500,000 loan. There's a break-even point on there, and
But let's stay on that for a minute, because there's some misconception about that. When you do a refi, you have to pay taxes again. The government in Florida, they charge you stamp tax.
Transfer taxes.
You have to pay those taxes again, and there are some costs associated with title as well.
Title charges.
So there's some costs to the refi, whether they're added into the loan or not added into the loan or
it's
paid by that
still
rate.
Happening.
There's
it's
still some charges.
And by the way, let's address one slick marketing thing that's out there, which is, hey, we'll do your loan with no costs. Okay, the charges we're talking about, the county fees, the recording fees, the title fees, these are fees that are mandated.
This is not the bank. It's not the bank's decision to say to determine
we're
whether
not
we're
going to
pay.
them.
Yeah, it's the government.
In those scenarios, 100% of the time, you're paying a slightly higher interest rate.
Right. Okay.
Now, slightly higher, it could be 1/8%, it could be 0.5%, it could be whatever.
It can make sense to do it sometimes.
Yeah, no. I'm not knocking them, but please understand, Scott, I want the lowest costs and the lowest rates impossible. You got to pick one, okay?
Right.
So that's the first thing. So now, if you're doing it to save money, there's two reasons there. One is you're freaking broke and you got to save money.
Right.
Like I talked to one client where he had a bunch of medical expenses he was trying to get through.
Right.
And it was simple. Bro, if you could save me $80 or $100 a month, I literally cannot tell you what a difference it'll make in my life.
Yeah. A cash flow difference would make sense.
I honestly think at that point, screw the long-term benefits of it. Let's just get them the help they need. Right? If that's not the case, if you're doing it for an intelligent move, then you have to start figuring out when is the break-even analysis and does it make sense?
Which we do all of that for our clients.
Of course.
We do a break-even analysis. We show you how long you need to stay in that house for that refi to make sense financially. Everything else being fine.
Exactly.
You're not needing a better cash flow at this time. You're not taking that money and putting it into somewhere else, which it's a whole other thing, right? A lot of people are not saving enough in their retirements. A lot of people are paying a lot of money in credit card debt. A lot of people really could use those extra $300, $200, $400, $75, like you said, to pay for medication, to pay for credit card balances.
There's a million things.
To put money away for the 401k, and at the end of the day, it might make sense. So that's rate and term.
That's rate and term.
The other reason why people do rate and term is, hey, I have a 30-year fix. This is going to be my forever home. I want to pay this thing as fast as possible. can I keep my payment the same, lower, or very close to the same, and drop the term from a 30-year to a 15-year?
Or a 20 or a 25 year.
Or a 20 or a 25, yeah. And the long-term savings on that
is
are
massive.
substantial.
Yeah. I mean, it could be 50, 100 grand,
yeah.
it could be more. So, that's the other piece of it. So, rate term refi, I want to lower my monthly payments. Either I need to, or I'm going to take the money, the savings, and reinvest it into ABC. Other option is lowering my term and building equity as quickly as possible. So one is cash flow, one is equity build up, and and that's the thing. I mean, if you're looking at somebody that's at 4 3/4 or 5.5 now, and we could drop them to a 15-year in the low 3s or whatever the number is, all of a sudden now we may be able to keep their payment the same and literally lop 8, 10, 12, 14 years off their mortgage.
Right.
And that's massive.
So Scott, I want to refi my house. I'm going to stay in this house for 2 years, purely financial. I just want to drop my payment. Does it make sense?
No.
No.
Probably not.
Probably not.
Assuming you don't need the savings.
Assuming you don't need the savings. So that's one of the reasons why you would refi. The other type of refi is a cash out refinance, right?
It's a whole different animal.
It's a whole different animal. What am I doing in this point? I'm taking the equity that I have built on my house, whether it's because of appreciation or because I paid that mortgage down, and then I'm taking that money out of my house. Pros and cons on this.
So, I mean, look, I think we got to start off, but the scenarios where people do that.
Well, people do that for a number of reasons. People do that, and look, when you do that, most of the time is for 2 reasons, right? It's to do improvements on the house. Hey, I want a pool, I want to add another bedroom, I want to whatever. Or people want to consolidate debt.
Right. There's a third option, though. And being that I'm doing this a long-ass time, I know this and you don't, maybe. But the third option is I want to take the money out and reinvest it. Because I'm doing 2 loans now for people that are doing a cash-out refinance, taking the money and buying an investment property with it.
Which they can do.
Of course they can do that.
They can do. They're allowed to use that money and put it into
I know that. That's why I'm doing the loans. In fact, I wouldn't do the loans if you can't do them.
Hey, Marianne, ¿cómo estás?
Maria, he doesn't even know about the investment thing.
That's not her name. That's not her name.
Okay. Anyway, so
yes.
So you can
3 reinvest it into whatever you want.
So home improvement, debt consolidation, or to reinvest.
Right.
Are the 3 options, and the home improvement thing is the home improvement and debt consolidation thing to me is super simple as far as whether or not they make sense.
Right.
On the home improvement side of things, there we go, Tyler. So on the home improvement side of things, it's real simple, man. It's just, is it improving your lifestyle, or is it a safety thing or whatnot?
Well, and the home improvement, you also have to be very smart to what you're doing with this house, because a lot of people just want to add things to their house for different reasons, right? And that's where talking to an advisor, talking to a realtor that knows what they're talking about makes sense. Because look, it makes no sense, for example, in most cases, to add a pool into a house if you're thinking that that's going to increase the value so much so that you can sell it for a lot more than what you're investing. Look, there's a lot of those improvements that don't make sense. If it's a lifestyle thing where you say, look, I love this house and all this house is missing is a pool for me to enjoy it forever, by all means, put the pool you want and enjoy the house.
Pull it up. And
I mean, you redid your kitchen.
I redid the hell out of my kitchen.
And same thing. You're not going to get the money that you put there.
I got to be honest, there isn't an improvement to your house that you'll get 100% rate of return on. There is no such thing as spending 20 grand on your house and your house goes up in value 20 grand. And I don't want to say there's no such thing. I'm sure there's exceptions if you do smart cosmetic improvements.
Comment below. What do you think is going to give you 100% return on investment? I'm very interested.
So I think a lot of the home improvement things are lifestyle choices.
Right.
And look, so let's say you're in a house. Or you're interrupting me.
No, let's say I need to put a new roof in my house and I don't have the money to do it.
Okay, that's fine. Yes. Okay, so that's fine. But the other side of it is this, that I've had this conversation with people. Hey, Scott, I'm thinking about either selling my house and buying my dream home.
Sorry, business.
I'm thinking about selling my house and buying my dream home versus I want to fix up my house.
Right.
All right, to turn it into my dream home. And look, when you're selling your house and buying another, you got real estate commissions, closing costs on the way out, closing costs on the way in.
Love it or listed. There's a bunch of shows like that stuff.
So it's a love it or listed type of thing.
It's a love it or listed type of situation.
So anyway, I think that's a worthwhile, kind of conversation to have with people.
Right.
Where it could make sense. On the debt consolidation thing,
There's two things that you need to think about, right?
go ahead.
What's the bad thing about debt consolidation? What's the problem with me taking money out of my house and paying off my credit card?
Getting yourself back into the debt position. Okay, so look, Scott, I got $40,000 in credit cards. I'm going to pay it off. Okay, that's really smart, assuming a year later you don't owe 40 grand in credit card debt. Or, hey, Scott, I want to pay off my car. That's great. Okay, we could pay off your car and save you $200, $300, $400, $500 a month. But we have now taken that car balance and rolled it into a 15, 20, 25, or 30-year debt. And let's just be honest, there's no freaking chance the car lasts that long.
Right.
Okay?
And the overall payment, if you count for those payments over that time, you end up paying more.
A lot more for the car.
Than if you were to pay it. Now, one of the things that you can do to mitigate that is reinvesting that money into the principal.
100%.
Or reinvest a part of that money into the principal.
And I know that's something we always run. We look at, without getting into too much details, these are the type of reports, though, that we put together that break down where is the cash flow analysis, where is the break-even point. I mean, we do detailed reports so we can advise properly.
And especially for cash out refis, we send you one where you can actually play with your debts and you can click which debts you would pay, what would it look like if you reinvested that money into the principal of the house, and how quickly you can pay the house. And a lot of times it makes a ton of sense. You can pay off the house in 16 years and save $200-300 a month.
Yes, assuming that people have the discipline to do it, and let's be honest, most people don't.
Most people don't.
So if you're a super disciplined person, yes, that's kind of the best of both worlds. But on the debt consolidation piece of it, that's what I think you have to look at. Generally speaking, rolling in things like credit cards and whatnot makes sense, because credit cards, unless you pay them aggressively,
25%.
Yeah, but even besides that, I mean, most people don't realize this. If you have $10,000 out on your credit card and you make, give or take, the minimum monthly payments, that's a 30-year debt.
That's what I mean.
So rolling that into a mortgage is not going to screw you up. Same thing with rolling in student loans. That's also, those are 15, 20-year notes a lot of times, so that also makes sense. That's one thing. Rolling a car in is where you got to start to be careful, because you're going to roll your car in, and then 3, 5, 7 years down the road, 10 years down the road, if you're super conservative, you're going to buy another car.
Right.
And at that point, in essence, you're paying for 2 car payments.
Now, in some cases, some people have car payments that are insane.
It's different.
And that have insane interest rates.
Yes.
I know. I used to work at a bank, so I used to see those. So everything is case by case, and that's why we provide you with this, with your debts, with your situation, with the equity that you have in your house.
And that way it can make sense. So look, you got to just, on the car things, on relatively short-term debt, 2 to 7 year debt is short-term debt. We got to think that through. Now, Scott, this is going to make my life easier. I'm going to save up the money, and in 7 years I'm going to sell the house and buy another one. Okay, fine. It's case by case. I'm not saying that you should never roll a car into your mortgage. I'm just saying there's an extra conversation that should take place.
Stop saying you should never roll a car into your mortgage.
I don't think I said it. I just said you got to be careful with it.
The truth is, with all of these things, where you can take money out, and it's just like credit cards, where you can take money out, or where you can lower a payment with no cost out of pocket, there's always pros and cons.
Of course.
And this is why it's important to talk to somebody that will actually take the time and explain these pros and cons to you, because it's very easy to tell most consumers, hey, this is going to be no money out of pocket, it's a no-brainer, and it's not always a no-brainer.
Right. And let's be honest, there's a lot of our competitors that's all they push. Hey, this loan's great for you, you're going to save $700 a month.
There's a lot of loan officers that only work in these times.
Exactly. Oh yeah. And by the way, you're going to get inundated now with crap in the mail and email offer. I mean, my clients are sending me 3 to 6 offers. Hey Scott, I got these in the mail this week. What are your thoughts? And obviously my thoughts are call me so I can make sure that we do this properly for you. But anyway, man, those are the considerations. We didn't touch on taking the money out for investing, but I think that's pretty black and white. Does the rate of return on your investment that you're doing exceed what you're paying on your mortgage? Yeah. And that's a relatively simple mathematical decision.
And it's a good idea to talk to an advisor at this point too.
Yeah.
Recession is coming and all that. Does it make sense to take advantage of the lower rates and then wait for that money later? Look, it's interesting times.
Yeah.
Rates are low. it's good for you to have the conversation, and we'll make sure that we give you all the tools you need to make sure that you make the right decision for your particular situation, for your family, for whatever your lifestyle is today, for whatever it's going to be later on too.
Yeah, and look, we always throw those reports out. So if you want one for your situation, DM us some basic information. We can throw it together, nice and simple.
All right.
I don't know. I think we're good.
I think we're pretty good, right?
Yeah, I'm going to Miami this weekend. If you're in Miami, hit me up. All right, see ya.
All right, take care.